Wall Street just posted its most violent single-day reversal in 8 months. The S&P 500 surged 2.3% in April 2026 as rumors of renewed US-Iran diplomatic talks flooded institutional desks. Retail investors are celebrating, but smart money is doing something completely different. While headlines scream de-escalation, institutional options flow reveals a $340 billion unwind that tells a darker story. This isn't about peace, it's about positioning. The VIX collapsed 18% intraday, the fastest volatility crush since the October 2025 Fed pivot fakeout. Energy sector call options that were pricing in $120 Brent crude got obliterated. Defense contractors like Lockheed Martin and Raytheon saw institutional put protection evaporate within 90 minutes of the diplomacy leak. But here's what CNBC won't tell you. The same institutional desks unwinding geopolitical hedges are simultaneously loading up on commercial real estate credit default swaps. JP Morgan and Bank of America just reported earnings. Beneath the headline beats, their commercial real estate loan loss provisions spiked 47% quarter over quarter. Office vacancy rates in Manhattan hit 22%, the highest since 1995. Regional banks are sitting on $890 billion in underwater commercial real estate exposure. So why is Wall Street rallying? Because smart money uses relief rallies to distribute risk, not celebrate outcomes. Let's cross-verify this thesis with hard macro data. The U.S. Producer Price Index released this morning came in at 3.1% year over year, above the 2.8% consensus. Energy inflation isn't easing, it's rotating. Crude oil dropped 4.2% on Iran talk hopes, but refined product spreads widened to their highest premium since February 2026. That means gasoline and diesel prices at the pump won't follow crude lower. Consumers will feel zero relief. Meanwhile, the Fed funds futures market is still pricing in only one rate cut by December 2026. Translation: inflation is sticky, monetary policy remains restrictive, and this rally is happening against a tightening backdrop. The second data point that contradicts the bullish narrative is corporate credit spreads. Investment-grade corporate bond spreads tightened only 3 basis points despite the equity surge. High-yield spreads actually widened 7 basis points. Bond markets are not buying this rally. Fixed income desks see what equity retail doesn't, deteriorating fundamentals masked by geopolitical noise. Now let's talk about the 3 tickers smart money is rotating into while retail chases the headline rally. First, XLE, the Energy Select Sector SPDR ETF. Institutional flow data shows $1.2 billion in accumulation over the past 72 hours despite energy stocks rallying. Why? Because smart money knows Iran diplomacy is theater. OPEC's spare capacity sits at only 2.1 million barrels per day, the tightest buffer since 2008. Any supply disruption from the Strait of Hormuz would send Brent to $140 within weeks. Institutions are buying the dip in energy, not selling the rip. Second, ITA, the iShares US Aerospace and Defense ETF. Defense budgets are locked in through fiscal year 2027. Geopolitical tensions don't disappear with one diplomatic headline. Institutional desks reduce short-term hedges, but increase long-term strategic positions in defense contractors by 18% this week. They're playing the multi-year cycle, not the 48-hour news cycle. Third, and this is the most telling, the iShares 1 3-year Treasury Bond ETF. Smart money is rotating into short-duration treasuries as a defensive hedge. When institutions buy short-dated government bonds during an equity rally, they're preparing for a reversal. They're not confident in the durability of this move. History gives us a blueprint for what happens next. February 1991. The Gulf War ceasefire was announced. The S&P 500 rallied 7% in 3 weeks on relief that Saddam Hussein's forces were retreating from Kuwait. Retail investors piled in, convinced the geopolitical risk was over. But smart money used that rally to distribute. By August 1991, the S&P 500 had retraced the entire post-ceasefire gain and dropped another 6%. Why? Because the underlying economic fundamentals hadn't changed. The US was entering a recession. Corporate earnings were deteriorating. The geopolitical relief was real, but it was also irrelevant to the macro cycle. Fast forward to April 2026. We're seeing the exact same pattern. US-Iran diplomacy hopes are genuine, but they don't solve the commercial real estate crisis. They don't fix sticky inflation. They don't change the fact that the Fed is still in restrictive mode. Institutions know this. That's why they're selling into strength. The options market is screaming this message. S&P 500 call skew collapsed to its lowest level since January 2025. Put skew on the downside barely moved. That asymmetry tells you institutions aren't buying protection on the downside because they're already positioned defensively. They're letting retail chase the upside while they fade the move. Bank earnings this week confirmed the divergence between surface optimism and underlying stress. JP Morgan reported a net interest margin compression of 12 basis points. That's the widest quarterly decline since Q4 2023. It means the spread between what they pay depositors and what they earn on loans is shrinking. Profitability is under pressure. Bank of America's investment banking revenue missed estimates by 9%. Deal flow is drying up. M&A activity is at a 5-year low. Corporate confidence is not reflecting this equity market rally. The most dangerous assumption retail investors are making right now is that geopolitical de-escalation equals economic acceleration. It doesn't. The two are decoupled in April 2026. Geopolitics provided a short-term volatility shock. Institutions hedged that shock with options and futures. Now that the shock is fading, they're unwinding those hedges and taking profits. But the structural economic problems remain. Commercial real estate defaults are rising. Consumer credit card delinquencies hit 4.8%, the highest since 2011. Auto loan delinquencies are spiking. The labor market is softening. Initial jobless claims have risen for 6 consecutive weeks. None of that changes because the US and Iran might talk. Smart money understands that macro cycles don't pivot on diplomacy headlines. They pivot on liquidity, credit conditions, and earnings growth. Right now, liquidity is neutral at best. Credit conditions are tightening in commercial real estate and consumer lending. Earnings growth estimates for Q2 2026 just got revised down by 3.4%. That's the 4th consecutive quarter of downward revisions. The setup is clear. This is a distribution rally disguised as a relief rally. Institutions are using the geopolitical narrative to offload risk to retail investors who are chasing momentum. The tell is in the cross-asset behavior. Equities are up, but bonds aren't confirming. Commodities are mixed, with industrial metals underperforming despite the equity surge. Copper, the PhD of economics, is flat. That means global growth expectations haven't improved. The dollar strengthened today, which is inconsistent with a risk-on rally. When equities rally on genuine optimism, the dollar typically weakens as capital flows into riskier assets. Today, the dollar went up. That's a defensive move. It signals institutions are hedging currency risk, even as they participate in the equity move. The final piece of evidence is insider selling. Corporate insiders at S&P 500 companies sold $4.7 billion in stock over the past 5 trading days. That's the highest weekly insider selling since November 2025. CEOs and CFOs don't sell into strength because they believe in the rally. They sell because they know the rally is temporary and they want to lock in gains before the reversal. So what's the institutional playbook right now? Fade the rally in cyclical sectors. Accumulate defensive positions in short duration treasuries. Maintain strategic long exposure in energy and defense, but hedge with put options. Avoid chasing momentum in financials, especially regional banks with commercial real estate exposure. And most importantly, don't confuse a volatility unwind with a trend reversal. This is a tactical bounce, not a structural shift. The macro backdrop hasn't changed. Inflation is sticky. The Fed is restrictive. Credit conditions are tightening. Earnings are being revised lower. Geopolitical relief doesn't override those fundamentals. History from 1991 shows us that relief rallies are distribution opportunities for smart money. April 2026 is no different. The institutions that are selling today will be the ones buying back at lower prices in 6 to 8 weeks. Retail investors who chase this rally will be the ones holding the bag when the reversal comes. The divergence between what the headlines say and what the data shows has never been wider. Wall Street wants you to believe this is the start of a new bull leg. The options market, the bond market, and the credit market are all saying otherwise. This is a bear market rally within a larger distribution phase. Smart money is playing the long game. Retail is playing the headline game. Only one of those strategies survives what's coming next. This analysis is for educational purposes only and does not constitute financial advice. All investment decisions carry significant risk. Always consult a licensed financial advisor before making any investment decisions.